Joining us now to discuss his value picks is Bill Nygren, Oakmark Funds partner and CIO. Bill, great to have you here on set with us for Overtime. So, Meta was a value stock for a hot minute. How, outside of just the traditional ways, are you defining value at this moment, and how should investors think about that for the second half of 23?
Well, thanks for having me, John. I think what's important for investors to realize is, as good a year as value had in 2022, that it's given all of that back so far in 23 and then some in a little less than 6 months. So in 22, when the growth names were getting hit so hard, at Oakmark, we were paying a lot of attention to growth companies that we thought GAAP accounting didn't do justice to their income statement. So companies that had a lot of income statement spending that we would add back because we thought it was long-term spending and should be capitalized. And it allowed us to purchase stocks like Adobe and Uber, along with some of the longer-term holdings that we've had, like Netflix, Alphabet, Meta. So that provided part of our portfolio and has certainly helped us do well versus value peers this year. But I don't want people to get a misimpression about Oakmark. Most of our portfolio is really cheap stocks on traditional metrics, and we think today's a great time to be a traditional value investor. After this big run that growth has had, and we've got the S&P up close to 20 times earnings, there's still lots of stocks out there that are at single-digit PEs that we believe, through a combination of dividend yield, cash flow reinvestment, and just economic growth, should be able to provide returns that are competitive with the S&P 500.
I'm afraid that with all of the AI excitement, people can't internalize what you're saying about value and dividend. People run to that when there's nothing to be, excited about. But give us a couple of names that you are most excited about in that value sphere and a bit of the narrative on why.
Well, I'm going to go back to 40 years ago when I was starting in this business, and everybody was looking at the big computer revolution. And investors ran up the stock prices of digital equipment and Burroughs and IBM. But the real beneficiaries were the companies that learned how to use data faster than their peers did. So a company like Walmart that effectively put Kmart out of business because they were faster adapting data. We're not trying to get into the chase on NVIDIA. It's a price point that doesn't make a lot of sense to us. But a company like Capital One sells at 7 times earnings, tangible book value. That company got started 30 years ago because the entrepreneur saw an opportunity to use data better than the big banks were doing it. And I think it's quite likely that Capital One will figure out ways to use AI to their advantage before their large credit card competitors do.
When you bring up Capital One, I mean, it speaks to opportunities in the financial sector and among some of these maybe smaller banks, as you just mentioned. I mean, given the fact that where regionals are concerned, you had investors basically tossing the baby with the bathwater. Do you see other opportunities along those lines right now?
Well, we saw other opportunities in the financials in the first quarter, especially after the SVB failure, where in Oakmark Fund we added a position in Truist, where we thought the market was too concerned about the mark-to-market risk in their mortgage portfolio and was not giving them enough credit for their non-bank businesses, which we think more than offset the mortgage hole, duration hole that they had. So I think there are a lot of opportunities in financials, but the single-digit PE group is much broader than financials.